Hello, namaste.
Hey, thank you for joining. Just give us a minute here and we'll get started.
John.
Hey, Prab. Hey, Reshma.
Hello.
Hello, welcome. Thanks for joining. We're going to give it another couple minutes for folks to join, okay? I'll give another maybe minute. Okay. I see folks coming in still. All right.
I think do you want to get started? Are you waiting for somebody?
No, let's get started and then folks can join in as we proceed.
Yes, and we also have a recording session, so this session recorded, so it will be published in YouTube, our website, and different other channels. So you'll have opportunity to go back if you need to or want to, or if you want to share this session with anybody else. With that being said, namaste. My name is Reshma.
Go over your going through here at Staggered. We've been underwriting a lot of deals lately, and it's exciting time. If you are in the real estate investment, please follow us and also sign up for our newsletter and call us, email us. Reshma and I are here to answer, as well as our marketing director Drew. So and then we also encourage you to join our sessions, webinars. But we want this and other kind of real estate investment venture to be kind of interactive. We want it to be mutually beneficial for everybody. So and then that's part of that is why we have experts coming in. We're not experts in everything, but we have a network of individuals that are in this industry and provide us with insights and valuable kind of information, guidance, etc. So thank you for joining. We will today talk mostly about taxes and primarily, in light of real estate investments. That's because there has been, as you know, a lot of, kind of regulatory procedures and maneuvers that people, or it's a process that you can take advantage of being in real estate, investment, um, for a number of tax benefits. And that's why we have invited today our very own Sachin Parajuli. He's a CPA. Sachin has been in the tax and accounting field for over 15 years. He works for a large firm, but also has his own company, and he has been, kind of primarily advising us on tax matters for Staggered. He's got, wow, over 450 clients currently. 40 plus are in real estate investments. So that's quite a stellar kind of, resume for Sachin. So without further ado, I'm gonna, let Sachin kind of start on. And Sachin, let me ask you a question. For this session today, Resma and I will take turns asking questions, but then feel free to kind of write your questions in the chat here or raise your hand, and we will try to make it as interactive and accommodate your questions. But we will also dedicate about 25 30 minutes of our session at the end for Sachin to answer any of your tax questions.
I don't see there are a lot of changes. It's normal, but in the future there might be some changes, like 20% business deductions that might go away in future. So maybe in next year or something. So there has been a lot of talks on that one. If we keep 20% business deductions, or we should just get rid of it. So because that will keep a big change how we can utilize that 20% deductions on real estate business.
Okay, thanks for that intel, Sachin. Given we have the business tax kind of primary for those who file on time. The business taxes are now past due, I guess. For those who have filed extension, they still have some time, and the personal taxes are due April 15th, I believe. Any kind of tips for our friends, investors, partners here on the personal tax side that you want to kind of share for this year?
Yeah, I guess compared to last year or private, like any prior years, a lot of people, they look for if they can, HSA contribution is one that they need to check on their W-2 if they have maximized their HSA. If not, they can still contribute to HSA out of pocket and then take a deductions on 2022 tax return. That's something they can look. And then also, depending upon their income, they can also contribute to individual IRA. So those are the things that can be done before April 15 and then take a deductions for 2022. So if we talk about personal, then if somebody has self-employed income, then they also can contribute to SEP IRA. That's something like 401k, right? For the self-employed company. That can be done before April 15. So those are the things they can take care and then get more deductions if they want.
Okay. That's very helpful. Thank you, Sachin.
Okay.
Um,
So I have one question for everybody here who have joined, right, and who have invested with us in Staggered. So now we have like under $10 million worth of real estate under management. For everybody who has invested in syndication deals specifically, what kind of tax documents they should be looking for? Should they wait before they file the taxes? Or like, how does it work? If you can just briefly explain that.
Yep. Based on my experience, I have seen a lot of people, they said like, oh, I just invested 200,000 in December. I'm not expecting any K1 or something. Technically, that's not correct. They should be expecting K1 because there might be some deductions, but so usually when you invest into syndication business or first year, let's say it's a development cost. So you might not be getting the losses on your K1, but still you will be getting your K1. So it's better to wait until you get the K1 and then file the tax return. Because if you are getting some kind of losses carried from your business, and then if you miss that one, you have to amend your tax return. So I prefer just to wait and then file the extensions. Keep in touch with your primary LLCs or whatever kind of business they have. And based on that one, once you get the K1, it's better to file the tax returns.
Okay, so everybody who has invested and not received their K1, even in the personal level, they should be filing extension, right?
Yes.
Okay. Okay. All right, thank you.
Very helpful. Thank you. In our flyer, we mentioned that we're going to talk about primarily how people could basically not pay taxes or at all by leveraging their investments in real estate. Now, I know it's not straightforward. It does not probably apply for everybody, and there may be some guidelines. And so we also mentioned 5 Ds. So maybe Sachin, if you would take one of those Ds and start talking about how one of those Ds. Let's start with depreciation. How does a real estate investor take advantage of depreciation in offsetting some of the taxes that may have from other income? I just want to add a kind of a qualifier here. Most of our investors, most of the investment are passive. So folks that join us have primary job or other source of income as their primary source of income. So what we're looking for is specifically how those taxes on those incomes can be offset through investment with staggered.
So basically, let's go back to the depreciation first, and then we can come like how these limited partners will be able to take the advantage of these losses getting from K1, right? So depreciation is basically it's a write-off of the building over the period of life of that building, right? So if it is a residential building, you can depreciate a residential building for 27.5 years. And if it is a commercial, then you can depreciate over the life of 39 years. So that means, let's say you have a building of 300,000. If you have a residential property, then you multiply that, like divide by 27.5, that's your deductions every year. And that's a non-cash flow deduction, because so you already paid cost to your building, and you're basically taking deduction each year. So that's basically, it's not a cash outflow every year. You paid that upfront, and then you are taking depreciation over the years. So technically, it's called non-cash flow deduction. So now, because since usually when I look at the rental activity, usually I expect a rental income, insurance, mortgage interest, property tax, depreciation. If it is a residential property, then I expect HOA dues, and some rental activity have utilities paid by the landlord, or some of them are paid by the tenant. So it depends upon who is paying that utility. But basically, you have these kind of deductions. So that amortization, like depreciation, is a big deduction. Sometimes if you have a property of, let's say, 400,000, you end up getting big deduction from depreciation. That will help you to reduce your tax rental income. So basically, when you say you don't have to pay tax on the rental, you are building your equity, but you are not paying tax on the rental income. So basically, before depreciation, your rental income might be, let's say, 10,000. If you have a depreciation of 11,000, you wipe out your rental income. So you're not paying tax on the rental income, but you are just building your equity from there. That's how we say you save tax from the rental business.
Very well. So maybe the next thing that comes to mind, Sachin, and a lot of people, I think this is important to understand, is 1031 exchange.
Right.
And we get a lot of questions on that, and that is one of the primary kind of questions that we receive, but also an excellent kind of a real estate investment
Mhm.
tool, if you will, to offset some of the gains
Right.
in the capital over time to build wealth. And that's what, staggered we, strive to be, is help folks build wealth. And so can you briefly just maybe touch on how, by investing in real estate and leveraging the 1031 exchanges over time, folks can build wealth?
Yep. A lot of people have misconception about this 1031 concept, right? So basically, what people think, oh, they come back after, like, when we file the tax return, they said, oh, I've sold the property, I bought the property, I qualify for 1031 exchange. So there is deferral of gain. So technically, it doesn't work like that. So to qualify for 1031 exchange, that's a deferral of gain. So you are transferring that gain from one property to another property. So in order to qualify for the 1031 gain, the most important thing is that there has to be third party holding it. Let's say you sold your property on July 1st. So during that time, you should have a third party. There is like a 1031 company. They are specialized on that one. That they are like escrow companies. So they need to hold that money, and then you need to identify the property, similar kind of property. So if it is a rental, then you have to find the rental kind of property. It's not like you cannot trade. It's basically you are not selling, you are trading. So there is a difference between selling and trading. So so basically, if you are trading real estate to real estate, then you qualify. That's one of the factors. But
I see.
you need to make sure that there is someone holding that fund. You identify the property within 45 days, and then buy the similar property within six months. Then that escrow company will hold that. Who is holding that money will get back to the person, like a seller. So that is the like an exchange. A lot of people think that, oh, I bought the property within 6 months and then I qualify for deferral. It doesn't work like that. So there has to be a process for like an exchange. A lot of people have that misconception and they fall into that trap. And then the other issue I have seen is, so let's say the partnership has real estate and they sold that real estate property, and then the partners got distributions. So the partners think that, okay, I'm now investing in the real estate, so I get that as a deferral.
Yeah.
So technically that's not, because it has to be from business to business. Like business has to buy and sell, right?
I see.
It's partner is like he's getting as a distribution.
Yeah. Once you get the distribution, that distribution does not qualify for a 1031 exchange.
Yes, it's a partner income. So because a lot of people have that question.
Yeah. Let me tone it down for our kind of guests here who probably are wondering, and if there are a lot of people who are new to this term, right? So let me back out a little bit and just explain. So 1031 exchange, the capital gains tax is where, say for example, you buy $100,000 worth of property. In 3 years, that property became $200,000 worth, and then you sell it. Well, you gained that $100,000. So in addition to your monthly or yearly income that you had on that property, because you appreciated that capital, there is what's called the capital gains tax. So that $100,000 of capital gains actually will be more than that, because if you depreciated the property and your property basis is now gone down to $75,000, now that $125,000, which is, over and above what you bought it for, is taxed as ordinary income. And depending on your tax bracket, could have a huge tax hit. What we're talking about is to defer that tax. Now, there's no getting out of taxes. There's always tax, right? Yeah. But you could defer that by making a light type of investment to where, instead of paying tax on that additional $125,000 in 3 years, you could invest that in real estate and then grow that to another, double it. So every 2 to 3 years, if you keep doubling it, you're not paying any taxes on that, because if you did a light type of exchange. And we at Staggered could help you do that. If you have another property, another light type of property, and want to convert that to 1031, we have network we have resources. So that's in the gist what we're talking about in 1031 exchange. Sachin, is there a limit on how much you can do? How many 1031s can you do for a investment?
So there is a certain rule that you cannot buy it from the related party or sell it. So that's one thing. So it has to be unrelated party.
Okay.
And then if you buy and then sell that property, so technically you can, there is no limitations. You can still like keep moving with these deferral. But I need to look at exactly if there is any timing or threshold. I can provide that information. On top of my mind, I don't know exactly that there is a limitation, but I need to look at that time. But yeah, there is a limitation for something. Like you cannot just deferral for like forever. So there is the point that you have to pay tax, but you can time, right? So whenever your income is low, you can sell during that time and the lower the tax.
Pay a little lower taxes because your basis will have decreased because of your other income. That's another good point. You know, so that's why we have experts like Sachin to advise us on when to exit, when to enter, what are some of the things.
Right.
Yeah,
So,
it's all about the timing.
Okay. All right. So we are pretty much at the 20 minutes mark. So I know that there are people who joined us from different stage of investing in real estate. So if you could just give us a brief overview, if somebody is buying their house for the first time or first rental property, for everybody in a very kitchen English, if I may, on benefit of investing in real estate in terms of taxes.
Yep, I have a lot of clients investing for the first time with their rental property, and then first thing is misconceptions. When they think that they can invest in rental real estate and then can offset the losses, that's a misconception I have seen in most cases. So technically, like I said before, you can build the equity but not pay tax, but you cannot use the loss. So there are different rules in order to understand how you can use the losses, right? Rental property. Just for example, let's say you have a rental loss of $10,000, and if you have a full-time job, this is like your investment, real estate investment. So now, if your income is married filing, if your income is 150,000 less, you should be able to claim the losses up to 25,000 as an active participation. That means like you meet 100 hours. But now, if your income is more than 150,000, you don't qualify for that 25,000 losses. Then you have to meet real estate professional qualification. That means you don't have to be realtor. There is a difference, because a lot of people get confused with the real estate professional versus realtor. So real estate professional is the number. There are a number of criteria that you need to meet. The first is 750 hours. So if you are a full-time job and then you have one rental property, then it's hard for you to meet that 750 hours. So that's one of them. And also the other one is you have to have more than 50% of what you are doing now. So that's also a difficult part.
Does that apply if the person that in question here who has 150,000 plus income invest through a third party a professional like Staggered, for example, and Staggered has that either through some sort of mechanism, can that be offset because it's invested in a organization that?
Yeah, technically not, because the person it's based on the individual level. It's not on the company level, because that individual person has to meet the real estate professional qualification, right? So you can have a losses carried over to your personal, but you might not be able to use that, offset that loss in the current year against your active income, your W2 income. But you can carry over those losses until the time you dispose the property or you have another rental income. So when we talk about that diversification of portfolio, right, income, so you have a rental loss. Let's say if you have another passive income, you should be able to use that rental loss against that passive income. The one example would be when you sell the rental real estate property, you have a huge capital gain, let's say. You should plan that capital gain or like selling of that property when you think that you have a big investment loss, stock loss.
Mhm.
So then you can harvest that stock loss against the gain on the sale of the property. So you can offset. Those are the things you can plan. So, and also you also need to think about the cash flow also, right? Because if you are getting, let's say your cost of your building cost is 100,000, but you are able to sell that property for 400,000, you have a gain of 300,000, and you don't want to look at the timing also. Oh, I'm going to look at like when my capital loss, if I have a big capital loss, I'm going to time that one. It doesn't work sometimes because you also need to look at the cash flow. If you are getting more cash, you don't mind paying some tax. So it's just like how you time. But going back to our real estate professional question, so that's something. But so let's say in order to meet that 750 hours, you can also include the hours from your spouse. It's just not the individual. You can use your spouse hours, and then other thing that you can do. So that 750 hours is per individual property or unit. So now that's hard, right? So in order to meet that qualifications, you cannot just like have 750 hours on one property. But if you have multiple property, you can make a group election because all these properties have the same economic reason. You can group these on the tax returns, and then you can have that 750 hours in total for all these properties. That can qualify. Because a lot of people, so there is a statement that you need to attach with the tax return to group them first. Even your K1, the same example. Now you have a K1 from your company, let's say, that has a loss. Then if it is a residential property or it's a rental property, then you can combine, you can do the group elections, including your K1 and all the rental properties. And then if you meet that 750 hours, you can utilize that losses from the K1 too. So that's how you can qualify for the real estate professional, meeting that 750 hours when you have a multiple properties plus K1 coming from LLC like staggered.
Okay. So one last question before we move on to audience question here. So next, like in stepping up a little bit more, right? And somebody who has been investing in firms like Staggered or in syndication deals, how do they benefit through cost segregation, and what is their real estate tax benefits looks like?
So now going back to the cost seg would be based on the operating LLC that holds the rental property, right? So now, so basically, like we said before, depreciation is 39 years for the commercial property and then 27 and a half years for the residential.
Mm-hmm.
But what cost segregation does, that's a special project. There's a like a specialized company doing that one. So let's say you have a 4 million example would be your building. That's commercial building.
Right.
So then that's depreciated over 39 years.
Mm-hmm.
Now, out of that 4 million building, with the cost seg study, we can figure out how much of that 4 million would be for 5 years property. Let's say your drywall doesn't last for 39 years. Your carpet doesn't last for 39 years. There are so many different sections of that building you can just identify and say these have short lives, either 3 years, 5 years, 7 years, 15 years. Then if you can just out of 4 million, if you can identify, okay, out of 4 million, 1 million is for 3, 5, and 7 years.
Mm-hmm.
Then you can either take the bonus depreciation, utilize like 700, like full amount as a deductions in the current year, or you can depreciate over the life, short life, right? 5 years, 7 years. So that's how you can, rather than taking depreciation for 39 years, you can take those depreciation in current year or spread for 5 years. And because of that one, you get more deductions in the current year. So now because your operating LLC will have that loss, and that loss gets passed over to you. But at the same time, you might be limited to use that loss in the current year because of the limitations. Now, if you have other rental properties, then you do the group election, combine all the rental properties with the K1, and then see if you can meet 750 hours. And if you meet 750 hours, plus there are like few things, then you can offset that income against your W2 income.
So there's really like a lot of ways, no matter you invest in syndication or not in syndication, real estate will give you opportunity to basically skip
Yeah,
legal.
it's as long as you follow the process and try to meet that requirement, you should be able to use. So even if you cannot use now, you should be able to use at one point, right? But so basically, like I said, you can build the equity, not paying the tax, but at one time you should be able to use those losses.
Okay, got it. Thank
Very
you.
good.
So I think now we should be there. I think few questions in the chat that we can take. Let's see if we can.
Yeah, let's see if we can raise this. A meeting chat.
Yeah, and everybody, if who have joined, if you have questions and want to unmute themselves and ask your question, please feel free to do
yeah.
so.
Yeah.
You should be able to do it now. So I'm just gonna ask you.
I have one question.
Go for it, John.
If you guys don't mind, I invested with this is more for Sachin. I did invest with Reshma and Prab on one of their real estate syndications, and I had to set up a retirement account for it, but I just remember it was very difficult and cumbersome for me to get that set up. Are there any tips that you can provide to make it easy for somebody to set up through a retirement account, through so any type of real estate investment through a retirement account?
So basically, when you said like you opened the IRA account, I guess you went through the trustee, opened the IRA account, then did you directly invest to the syndication, or did you create an LLC to go through that process? How did you create the structure?
I'm trying to remember all the specifics, but yeah,
He
set it up
directly contributed to Staggered. He did not have that. So yeah.
Yeah. And it was through
Okay,
the
so-
IRA admin.
Yes, it was through IRA.
So basically, IRA is already created, and now it's the owner of the syndication business, right? So it's taking the IRA is going to get the K1 from the business LLC. Is that the case? Yeah,
IRA
Is
is
going to get a K1. That's correct.
yes.
Yes, because you're basically trying to defer that income by not recognizing now, just putting into IRA, and then after 59 and a half years, you're going to take that out. That's how you are trying to set up the IRA, right? Yes. But yeah, I know I have seen a lot of issues with this. When you set up these IRA, there's a lot of trustee and legal process that's different than the tax. So it's a complex process. I have seen that. But in terms of tax,
doable.
yes.
Okay,
Yeah,
thanks.
like,
I just wasn't sure if there was an easier way to set that up. I appreciate you telling me there's not. So I realized
no,
I didn't
it's,
take any unnecessary steps.
Yeah,
Yeah,
so
no,
we started this session, we were talking to Sachin for a little bit, and then I was telling him that I can, there were times when I can see my 401k and my retirement account going down, even though I'm contributing it to it every month. And how do I stop that from happening? Because, how does that work? Like I'm adding to it every month and the value is going down. And by the time I retire, like, what if I find out that there's nothing left in it, right? So, but I think, if I had an opportunity, or there's a lot of us who had an opportunity who, like, not through directly through 401k, but different other ways to invest through real estate versus like depending on somebody else to invest your money, I think they would rather prefer that. And I was very thrilled to find out that IRAs can be invested in real estate through self-directed. So
yep. You can do through self-directed IRA or Roth IRA. And then you can defer your income up to that point. So you basically, if you think you are going to recognize income from K1, it's better to just push to IRA and then get it.
Yeah. So just to recap, then, if I have W-2, my company provides, 401k or other, great. But if I'm at the, supplementing it, or even if I don't have a W-2 job or have a W-2 job that does not provide 401k or retirement savings, what you're saying, Sachin, is through investing in real estate via the IRA, you could get the same benefit, tax deferment, plus the appreciation and all that comes with real estate investment.
Yeah, and then I think so. Roth IRA would be a good example because you can defer, and at the same time, earnings is not taxable, right? When you take it out. So I would like a lot of people prefer to invest in Roth IRA
Oh, I see. Okay.
because it will grow. And then when you're young, and then a lot of because that's the how your income will grow through Roth IRA, and then your traditional IRA you take deduction now, but your earnings and then the growth is taxable when you take it out, right?
Yeah.
So it's like if you think that you will have more income after you retire, then you end up paying more tax, but we don't know the future of US tax in that time, right? So it might go up more than 50%. The way it's going up, it might go more. So basically, if you do, a lot of people prefer to put in the Roth IRA, and then because that will help you save more tax in the future. That's how people see.
Okay. Great.
That's great. Reshma, I'm thinking like we should, given that we know this and a lot of folks don't, and probably have the hoops that John had to cross,
Right.
we might want to just dedicate a session in future for how to set it up,
Okay.
and the details. And I hope, Sachin, we can bring you back here, given you're so knowledgeable about, you're so informed, and, it would be good to have, some of the participants here learn more about how they can leverage their IRA or invest in real estate. Right? And I have a comment here. I said it's a brilliant idea to use IRA for real estate. So thank you for that comment. And then we have a question here. Maybe I'll read. Sorry, I'm having to lean here because I have a little bitty monitor that I have in front of me. That Sachin, I think this is a question for you. What are some of things that you can depreciate on a rental property? Landscaping, preventative maintenance, improvements? That's a question. Sachin, any thoughts there?
Yep. So basically, the standard deductions you can take is insurance, property tax, and then if you have a management fees, HOA, your mortgage interest, and utilities if you have. And then besides that one, with a lot of my clients, what I have seen is landscaping is one. So now it depends. So landscaping is, if it is a land improvement, it's a 15 years depreciable property. So when we say 15 years, you can still take bonus depreciation and utilize all the deductions in the same year. Or if you elect out of bonus depreciation, you take over the 15 years. So, but if your expense, or like let's say expenditure is less than 2,500, under the safe harbor rule, you can make as a deductions. So basically, all like improvement, I have seen like people putting 20,000 as a improvement and they want to deduct that one. Technically, it doesn't work like that. So
I see. Basically, it's a capital improvement or expense, right? Those two are the terms that you're going to look at, whether it's a capex or an expense.
Right.
Yeah. Basically, if it adds value of the building, that's a capitalized asset, like a roofing, right? So if you put window, that's more capitalized. But if it is a carpet or something, you can expense that one, depending upon if it is more than 2,500. If it is a carpet or furniture something, then you can take a depreciation, but at the same time, you can take a bonus depreciation and utilize all the expense in the same year. But if it is a roofing or any kind of big expense, I would rather take any deductions. We should capitalize and take depreciation over those.
Right. Is it fair to say if the investment improves the property value or increases the property value, is not one-time deal. It's something that, either generates additional income or makes the, place dwelling better, then that's a capital investment and you depreciate it. Versus lawn maintenance, for example, cutting grass, you have a leak in one of the pipes and you fix it. That's one type. Deals like those are more expenses that you should deduct in your annual tax.
Yeah. And then also you should keep in mind that when you try to take depreciation, you should think for the longer run. If you're trying to sell that property within this short period of time, that depreciation gets recaptured as an ordinary income. So that's something people don't realize, that let's say you're taking depreciation now and you're utilizing that loss, you're taking against your ordinary income. So when you sell that property in near future, that depreciation gets recaptured as the ordinary income. So usually you might expect, okay, my capital gain is 1231 gain is 200,000, but you might get surprised that out of that 200,000, some of these capital gain is your ordinary income. That's how it works. So basically it gets recaptured. So there is a calculation, like it will look at your total capital gain, and then it will compare how much depreciation you have taken so far. And based on that one, there is a calculation to determine how much of this should be recaptured.
Right. And that's one way where you can, kind of stagger your tax burden is by, and usually it's capital gains probably taxed at a higher tax rate. So by making that depreciated amount ordinary income, depending on your tax bracket, could be more advantageous.
Yep.
Okay. Awesome. Do you want to read the next question?
I think that's the question that Sachin was answering. What happens to the depreciation amount taken, over the years when you sell the property, pay tax on the amount when you sell it? I think this is the question that was just.
So I think there are two things here. So one is, as you take the depreciation, it will reduce the value of your cost basis of the property. So let's say your cost of the building is 200,000, you take depreciation of 10,000 for over 3 years. That means you took depreciation of 30,000. That will reduce your cost basis of the house by 30,000. Now, your property is 100,000, your depreciation is total 30,000, so your basis is 70,000. When you sell the property for 200,000, the capital gain is not the difference between your original cost and then 200,000, that's 100,000. It's the difference between your 200,000 and then that's 70,000. So you have a gain of 130,000. So out of that 100,000, that 30,000 might be recaptured its ordinary income.
Okay, so I know there was somebody who commented that it is a brilliant idea for people to invest through IRA in real estate. I just want to bring up like situation that I know. In 2019, I have somebody who paid taxes and invested through Roth IRA in a single family home in Charlotte. And since the property value doubled from $400,000 to close to $800,000, because it was through Roth IRA, all that money that she has made in that real estate was now tax free since it was through Roth IRA. And that's really like a legal and right thing, and there was nothing shady about this, right, Sachin?
No, that's the correct way of doing. So it's a good strategy to use that you can utilize
to do a Roth and then invest and have the cash flow go to the same account, get the appreciation and then capital gains if you're selling or refinancing to the same account, so that you don't have to pay any taxes when you invest it through Roth. So it's something really to think about.
And then also, I don't think we talked about the installment sales. So that's something that's also a good way to defer your capital gain over the years. So basically, when you sell the property, if you don't get, you might go with the seller as a finance property, right? So it's like you buy the property with a note receivable. not payable to the seller. So if you do that one, you don't have to recognize all the income in the current year. You recognize the income over the years when you pay the cash. So by doing that one, let's say your income is too high this year and that capital gain might change. So basically, when we look at the capital gain, let's talk about 15% versus 20%.
Right.
If your income is up to like certain threshold, you might end up with 15%, but if it goes up, you might end up with 20%.
Right.
So then, depending upon your active income, you might need to think about the timing of recognizing that capital gain. If you are going to recognize that capital gain this year, and it will drive your AGI higher, that triggers to 20% capital rate, then you don't want that, right? Because you want to shift that, and maybe in that case, you might, if somebody agrees, then you might want to go to that installment route, and then defer your income over the years. So, and also, in order to, like, other thing that you need to know is when you have a sale of the rental property, it's an investment. So there's a 3.8% additional tax if your income is more than 200. Your AGI is more than 250,000. So it's like, if you are like 15% bracket, like if you are in 15%, it's 15.3.8%, or if you are at 20%, it's 20 plus 3.8%. That you have an additional 3.8% tax. So you have to be careful. If you have more than 250,000 income with this capital gain, then you might need to shift your income so that you don't fall into that extra 3.8% also.
Oh, wow, okay. So is this predominantly seller financing that you're talking about, where the seller becomes the bank and you pay him every month instead of paying bank?
Yes. Yep.
Okay. Yeah, I think we will see a lot of those deals in the market as the interest rate has been going up, and people who really need to sell the property and have been holding that equity either are doing assumable loans, meaning we pay the loans in their behalf, or they would be doing seller financing. So for their equity, right, whatever they have in the property, so we will be paying them a certain amount every month with the interest rate that they determine, and doesn't have to do with anything about market interest rate doesn't really apply, because we're paying directly to the seller. And for seller, it's a good deal because he will not be paying capital gains altogether, and he will get his payments. Some people who are in their retirement or moving towards retirement wants to do this because they have steady income and they really are holding all the cards, because if, let's say, somebody defaults on their loan and doesn't pay, they can have their property back and also keep the down payment in most cases, right? Or a good chunk of it. And if they do pay, then that's a passive income without being involved in the property and not paying taxes, right? So it's really a win-win situation for both, especially in this market where debt is so expensive. Seller financing, I think, would be the way to go for any and all investors who are trying to buy in this market.
Yep.
All right. So with that being said, we don't see any more questions here. If you want to unmute and ask anything you have, let us know.
Yeah.
Oops, I'm sorry. There's one question here. When you get to the end of the depreciation period and you still, what is the best thing you can do?
Can you repeat that again?
Right. So when you get to the end of the depreciation period for a property, what is the best thing you can do?
So that means like you ended up with a salvage value, right? That's zero. So your basis is zero, technically. Your cost minus economic depreciation is zero. So basically, you have a huge gain. So that's a good thing, because you don't have anything to pay, or like, I guess when you say you have a full utilization of depreciation, you're holding that property for either 27.5 years or 39 years, depending upon if it is a commercial or residential, right? So that's the thing. You might either go with the like an exchange, or you can go because you are expecting a high capital gain there. because of the difference between the cost. So you might either go with the capital, your like an exchange. So you might find another property and then invest there, so you can defer. But yeah, that if you can keep your property for 27.5 years or 39 years and then sell, I'm sure that the value will go up. You'll have a huge capital gain, and then you need to think about how you can defer that income. That's how you have to think.
Okay.
Great
All
question.
right. Great question. I know. So I think before we end here, there's like the most popular question that people ask: why does Donald Trump not pay taxes? Such a
Yeah, because I guess that's in the biggest scale, right? So how we think about all these real estate professionals thing, like meeting that 750 hours and like all these cost seg study. So this is how they can break the longer life of the property into shorter life and then just wipe out all this. I have worked with a client, they had 3 million income, but they were investing in the commercial property, and then we were able to wipe out all the income because they had a commercial property of almost like 14 million. Out of that 14 million, we're able to get short life depreciation for 6.5 million, and we wiped out all the income, active income. Because first thing, before you go into the cost seg, you have to make sure that you meet that real estate professional. Because even though you use cost seg to offset, to create a huge loss, but you might not be able to use that loss if you are not an active or like real estate professional, right? So you have to make sure that, okay, we looked at, okay, you qualify for the real estate professional by grouping all this rental property as one property, and then we did the cost seg study, and then took a big bonus depreciation. So also keep in mind that bonus depreciation is something, it's going away from 2023. So in 2023 it's 80%. You could take 100% prior to 2023. Now it's going to be 80% in 2023, then 60%, 40%, and then by 27 I think it will be zero. So you won't be able to utilize that bonus depreciation. And then for rental real estate, there is no section 179. That's like you can use the full deduction in the current year. So we don't have that option. So because of the bonus depreciation, this cost seg study was on high, like a lot of people were utilizing that, but depending upon the rule change, it might go away. You can still shorten the life of the assets from 39 to 27 to 5, 7, or 15 years, but we might not be able to use that bonus depreciation.
I see. Got it. So we have one more question here. In terms of tax strategy or tax benefits, what is the difference on long-term holding the property? What would be your strategy on the short term?
Yeah, so basically, like if you hold the property for short term and sell it, it's an ordinary income. If you try to keep that property for more than 1 year. So the other example, that's one, try to sell that after 1 year so that you fall into the long-term category. And depending upon your income, you might end up with 15% or 20% plus 3.8%, right? The other thing that if you're converting your personal house to rental because you wanted to buy another house, make sure that if you're trying to sell that house within 3 years of your rental so that you qualify for that home exclusion, that 2 years out of 5 years rule, and you don't have to pay any tax on the capital gain. You only have to pay the tax on the recapture of the depreciation you have taken for those 3 years. So that should be something that you can utilize.
That's an excellent tip, and I see a lot of folks in that situation where they either for one reason or the other hold on to that property for longer, but it's not a long-term hold, but they just missed that 3-year window, and will put you in a bind. Because if you are planning to sell next year, you could save a lot in the capital gains tax within that 3 years of your moving to the new house.
Okay. And like for the audience here who are in their first home or planning on buying a second home or getting a primary for themselves, right? This might be something you want to really, dig in. If you have any questions, reach out to us, and then we can connect you to Sachin. I don't know how much time he has because he was super duper busy this
Yep.
tax season with all this
Yeah,
calamity.
I can answer after April 15th.
Yeah.
Sorry, I'm still not sure about that.
Oh, see, still not sure about Sachin answering questions.
But yeah, I guess I think we're coming up to an hour here, and
Right.
Sachin, before we wrap up, we really, really appreciate your time.
Mhm.
I want to thank you for your, such a passionate kind of participation,
Right.
especially the way you've been helping us staggered,
Yeah.
grow and try to navigate through all of these tax situations is really helpful. But most importantly, being here available today to answer all the questions that we had and educate our guests here in the session. Thank you, Sachin. I really appreciate it.
Yeah, it's my pleasure. So yeah, I was sorry I was not fully prepared because it's super busy time, but still I try to contribute how much I can. And then if you guys have any questions, you can reach out to me in email or something. I can help you guys.
No,
because
and
there are
I want to recognize.
there are a lot of misconceptions about rental property. Understanding those things, I can help.
Sure, and we would like to kind of bring you back after the tax season, of course. This is really busy time, so extra. Thank you for making yourself available.
Right.
One after a time is very, very helpful, and we will try to maybe after the tax season bring you back one more time, or maybe a few times. And for those who are in participation, if you have any questions related to tax, legal, or any other questions related to real estate, we would love to hear.
I have like 300 pages here for the real estate tax planning. I can explain more about that.
Thank you for that. That book will be handy. And so email us, call us, write us a letter, whatever fits best for you, your time. We're here. We're happy to help and learn and grow together.
Yep. Yes, and very grateful for the audience today who asked questions and who didn't get to ask their questions. www.staggerequity.com might be the way to go. We are also in Facebook, or you can call us directly or call Drew. We will try to help you as much as we can. But yeah, thank you for joining this session. And
until next month.
Namaste.
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 Good night.
Thank you.
Thank you.